Now, here in the U.S., we do have Treasuries extending their slide after the Fed yesterday said it will gradually slow its purchase of government securities. So for a look at what this means for U.S. bonds and the global bond market, we bring in Charles Diebel, head of European rate strategy at Nomura International. How much of what the Fed did yesterday and what we're seeing out of Europe today changes the view on bonds overall? We've seen quite a sell-off in bonds this year. Does that continue?
I tend to think here that although we've passed some of the big events, we're still in summer market conditions. Volumes are light, and at the same time, we still have a news flow that's relatively positive and upbeat. So, we're still largely being driven by risk assets. So, for the time being, I think, we're still in a relatively defensive condition for bond markets.
Okay, we'll be right back with Charles Diebel in just a few minutes. We are speaking with Charles Diebel. He's the head of European rate strategy at Nomura International. And Charles, before the break, you were talking about being in summer market conditions. Now, given all the news that we have gotten today out of Europe, as well as the Fed's statement yesterday, how different would it be if this were to come out in the fall or later on in the year when we do have more market participation?
Well, I think to be honest, the reaction yesterday to both the 10-year note auction and the Fed was relatively muted. We have backed off a little bit from the levels that we established overnight, but nonetheless, we're not vastly changed. I think if we had full market conditions, we may find that people would be more willing to fight the risk rally at this point in time, because that's basically the primary driver that we're facing. This acquisition of risk, this risk appetite, the perception of the V-shaped recovery is all helping to drive risk assets higher and putting bonds on a relatively defensive footing.
So the risk rally would be stronger if not for the fact that we're in the slow season?
Potentially, yeah. But at the same time, we have a relatively cautious stance on how valid this risk rally is. We tend to think that, we're in an environment where certainly between now and the end of the year, the macro data are probably going to disappoint versus expectations and certainly versus what's priced into the markets. And on that basis, we actually think that when the markets get back to full strength and we start to see some more tepid macro data, it's not necessarily a double dip, but certainly not as strong as is implied in the market pricing, that we start to see a more constructive environment for bonds emerge towards the end of the year.
Now, we do have quite a bit of government supply debt coming out this week. You've got the 30-year auction today as well as a 10-year auction in Germany. What kind of demand do you see for debt on the long end of the yield curve?
Well, the auctions so far this week have gone relatively well. We did see a sizable tail on the US auction yesterday, but the overall demand level was pretty good. The Bund auction yesterday was pretty strong. I tend to think that, particularly now that we've got the major hurdles of the FOMC out of the way, that the 30-year could go relatively well. One of our major themes going forward is that this idea of a steep yield curve and very low short-end rates for an extended period of time, as the Fed confirmed yesterday, will progressively encourage a yield hunt type move out the yield curve as investors seek returns. So that will eventually see the curve move to more of a flattening bias. So, I think the setup for the 30-year is relatively good.
Okay, thank you so much. We were speaking with Charles Diebel, the interest rate strategist over at Nomura International in London.